All right.
And even like the presidential election year in general is positive 75% of the time, like total.
That's surprising.
And if you look at the quarterly breakdowns, so I think the percent positive was the most important thing because it goes you're 58% positive Q1, 58% positive Q2, and then 62 and 75% in the final two quarters, like looked at independently. So the closer you get to the end of the year, the more positive
That makes sense.
you're likely to be because you're getting closer to the election.
Yes, it's like the whole thing with markets and politics. Like the market doesn't really care who's president.
Right. It just cares about what to expect.
Yeah.
Which is like, yeah, like the worst thing from markets in general is just uncertainty because you don't know what to expect in any way. And so then when you look at it from like a political standpoint, it's like when
to expect
you give people a paths to like potential paths to go down, it's like just more clear.
It's like similarly when everyone's screaming about there being a recession, all these companies prepared and all these individuals prepared. So there wasn't a massive hiccup or like a big shock to the system.
And I was thinking about that because the earnings guidance in this most recent deal like hasn't been as positive. Companies have been beat up a lot more, and like they might beat on revenue, beat on EPS, but then their guidance is down, so the stock gets hit. But it's like, okay, you're guiding lower, expecting a downturn. Like if that happens, then sure. But if it doesn't, then that could set us up for a pretty solid rebound.
Well, think about it. They don't want to go out and say like, hey, things look fantastic.
We're going to keep this.
We're going to crush it.
Yeah.
Let's set ourselves a low hurdle and then beat it.
Right. Right. Exactly.
Which is, Michael in our midweek macro stuff, he's like talked about that before. Yeah. Like they manage expectation down and they beat them.
Every company,
which is why I kind of hate.
Every business does that in particular. Like when we're setting. When we're setting goals, you're just like you want to lowball it and then you outperform. So it's like, I don't get why everybody's so shocked that companies might be doing that this time too.
Right, yeah. Hey there, everybody. This is Will. I got Ian with me for this week's podcast coming out Friday, May 3rd. Ian, a lot of stuff to talk about. We were talking before we started recording. I think we probably just should have kept the first 10 minutes of our conversation.
Hey, we can edit, right?
We might cut back to that.
Yeah, we'll cut back.
No, but seriously, I think we have some good stuff to talk about today. Entering the month of May historically brings some good conversation. You've probably heard the adage, sell in May and go away. It's been around for a long time. It's the idea that markets tend to produce a bulk of their returns from November through April, and then that May through October is typically a weak period for the market. There's some pretty good data on it historically, but as of late, you really haven't seen that play out. I'll quote Ryan Dietrich to start, and then we'll have some of our own stuff as well. He highlighted S&P 500 has been up in May 9 of the past 10 years. So maybe we modified this to sell on June. But seriously, I mean, for 9 of the past 10 years, May's been positive. The only May that was negative in the past decade was 2019. We also should be cognizant that we're in a presidential election year. I know, Ian, you've done a lot of work on this, which we'll talk about in a bit. So does that have anything to do with May returns? Data says a little bit. Election years, average May's 0.5% gain.
Yeah, we're coming off a month in April it was bad, right? I mean, like bad just from a straight performance standpoint. We saw, I think we ended a 5 consecutive streak of monthly gains for the S&P. We had some bit in the report, which we can get to there in a sec, but that ended in April. We saw the S&P kind of pull back. It hit a 5% pullback intra-month, which we hadn't seen in quite a while. Going back to that S&P 500 chart, I think we just did a series of podcasts on that. It just continued to add X's on that default chart, 32 X's in a single column from that October 28th. But who's counting, right? But since then, I mean, when you're looking at a chart like that, you're like, wow, that's a big stem.
Yeah.
And you don't get support on a chart like that until the prior lows. And so the fear is you see it go up, what goes up might come down. We've gotten 5 consecutive buy signals throughout the first few months of the year. It's a pretty good looking chart. I mean, if you just look at the S&P 500 chart, 5 consecutive buy signals, positive trend.
You can also think about it in terms of performance. So year to date, S&P is up like 5% at this point. But if a bulk of that return came, it was like a really hot January.
And you're talking about the election year stuff, and we ran some numbers on. I mean, there's a lot of conversations around election years, and we were talking before jumping on. I mean, a lot of the the difficulty around the election year stuff, I think just circles back to the broad idea of just uncertainty. Historically, over the past 25 election years, so going back to the end of 1927, including 1928, you're about flat in the first half of the year on average. Second half of the year, much better.
Yeah, I mean, I'm sure there's a bunch of tail risk funds that are pitching, like elections as a potential catalyst for their fund.
And it sells headlines. I mean, that's the thing. But you see it I mean, over the prior 24 instances, markets have been positive in an election year 75% of the time.
That is a stat that I don't think most people would.
There's not much red on that. There's just not that much red numbers that you can see on the screen. And in the second half of the year, you're positive 83% of the time. So that's literally, there's been 4 negative second half of the years and during election years over the past almost 100 years.
That is wild.
That's pretty remarkable, right? Yeah,
that is not getting broadcasted on the news.
But you're looking at years there, 1948, 1956. Neither of us were around then, so we can't really speak to those environments.
Far from it.
But the other more recent years, it's all negative second halves and sharply negative second halves. 2000, we know what happened then.
Okay.
And then 2008, right? I mean, other than that,
table's wild.
You're looking at pretty strong results in the second half of the year. So
yeah, I love studies like this and tables like this because people try to politicize the market,
right.
But you can see that the market really doesn't care.
Right.
It just cares about what it knows and the fear of what it doesn't know.
Because we were talking before, all of your primaries are wrapped up in June. And so then starting in July, markets know it's going to be 1 to 2 people typically, right?
There's another tweet by Urian Timmer. He's at Fidelity. He was talking about the amount of time that the market's been in a downtrend off its 2-year highs. So we're just, like you said, slightly off the all-time highs. 65% of the time, the market's in a 5% drawdown from 2-year highs, which is more than you would think, I guess.
Right.
And then 50% of the time, the market's at a 10% drawdown from its 2-year high. So again, go to show that this is super normal behavior. Don't let a ton of recency bias creep into your investment process, what you think about the market. We're not making new highs every day. That's not sustainable.
Yeah, even though we felt like that for a little bit at the beginning of the year, right? And we just continue to rocket higher.
All right, hard pivot. We're talking Thursday. Yesterday was Wednesday. We got the latest FOMC decision. Rates were unchanged as widely expected by the market. Rate cuts continuing to get punted. Powell's comments following the meeting were similar to what we've heard from Fed officials over the past couple of months. They need to see more evidence that inflation is moving toward 2% before cutting rates. However, and I'm reading a piece from our report, however, Powell did say it is unlikely that the Fed's next move will be to raise rates, which may release some of the upward pressure on yields. Powell also said that the Fed will reduce the pace of shrinking its balance sheet. It's funny, the market rallied right after and then closed negative on the day.
I think you sent a poll out in our research chat.
Yeah.
Which is, I think we do every Fed day, just right at 2:05 p.m. Is the market going to close positive or negative today? And everyone said positive.
Everyone said positive.
And it ended up closing negative. So maybe that could be the indicator next time. If everyone says positive, then we know it's going to be negative.
It is funny. It's all right, we're going to give the market what it wants, and then the market doesn't like it.
Right. Yeah.
Qualitative note on the rate environment. I was talking on a different person's podcast last week. With rates where they are right now, it's hard to say it's unattractive. I mean, I think there is potential think about demographics, people retiring, shifting their portfolio to meet their needs in retirement, institutional money, having to meet certain liabilities, 5% plus risk free right now. I would think that's causing a bit of a headwind for equities, or maybe pulling out a bit of the demand to say that, we don't need to go out and on the risk spectrum to get the return that we need to meet our liabilities or to fund our lifestyle. So I think people, complaining about rates moving up, mortgage rates, that's a different story, but complaining about rates where they are right now. And I think there's some really good potential or good outcomes for the current environment.
So just to pitch this out there, so 5% being that kind of potential area that you could look toward.
It's like a 2-year treasury.
What do you think about it also setting up as kind of like a baseline? Look, I got to beat that 5%. So how am I going to beat that 5%? I'm going to go invest in more growth and oriented stuff, right? Because from an advisor's perspective, I mean, if someone can just buy a 2-year at 5% and kind of get that performance, well, I got to show some value here. I got to.
That's interesting. I would first respond as what are you investing for?
Right.
a
It
lot of
depends on the
people,
client.
it depends on the client, but a lot of people I think have forgotten why they invest. The reason to invest is not to make your account value bigger. The reason to invest
You
is
sure?
for some people, for some people it might be like the reason you're investing is for some type of goal. Maybe a goal is to leave as much money as possible behind, sure.
Yeah.
But I feel like for most people, that's probably not the goal. It's
Mhm.
to fund retirement. For institutional, it's to fund certain liabilities, to fund growth opportunities, to fund investments. On the individual front, it's to buy a house in 5 to 10 years. So like know why you're investing first of all. And if you can do that with lower risk assets, then so be it. If not, then yeah, absolutely. You have a higher hurdle rate to add value than
Right.
the risk-free rate, and that could promote, yeah, some more risk taking for sure. But again, I would start with why are you investing in the
Yeah,
first
I think
place?
that's a fair point. I don't know, something else, food for thought to think about.
No, it is. Yeah.
Moving forward into the summer.
All right, you want to do some earnings stuff over the past week?
Yeah, I think there's some pretty interesting movement. I know we had some notes in the Where You Were yesterday talking about everyone's favorite coffee shop, or apparently not everyone's favorite coffee shop.
Apparently not.
Starbucks, right? I mean, I know I see. It's funny. I kind of stopped going to Starbucks right when the stock started going lower. So I guess that must be the catalyst there.
Yeah.
But we saw some pretty negative movement from Starbucks yesterday, which just underperformed on kind of all of its earnings projections. It's also kind of lowered guidance moving forward. Stock did not like that, or investors did not like that very much.
Do not care for that. Yeah, and now this was a technically weak stock going into
It
earnings.
was.
So which is a key point.
Moved to a negative trend in January.
Correct. We rate all the stocks on our system 0 to 5. This was what, a 1, I think?
Yeah.
Maybe
Yeah.
going into earnings. So almost the lowest technical rating that you can have. And are we cherry picking? Absolutely. But the general data will confirm this as well. Like lower rated stocks typically don't perform as well on earnings. I think
Right.
part of that is technicals kind of leading the fundamentals, market kind of sniffing out maybe what's going on beneath the surface.
I was talking about a little bit with Miles this morning. The Carvana chart.
I've not looked at Carvana.
That is so it had reported earnings yesterday. It's
Are
up
they still a company?
38% today. It was trading around $5 at the beginning of 2023. It's currently $120.
Oh my gosh.
It has seen a massive rise. I mean, I remember we were joking around it.
There's a tower like down the road from me.
The all-time high for this stock is $376 in August of 2021, and it fell to below $4 at the end of 22. I mean, talk about a beat down. I think everybody was thinking that that thing was going to zero, right?
Wild.
And I kicking myself because I remember looking at it at the beginning of 2023. I'm like, what are they going to do with all these towers? They can't just get rid of them. So like, I don't know, they got to do something to turn it around.
What? I guess they did.
Yeah, and so I mean, they're seeing a lot of improvement. They had Super Bowl ads. I mean, they're seeing that it's up 64% year to date.
Money's coming from somewhere.
Strong 5 for fiber. Maybe a name you might not want to add to. Probably around 120% overbought.
A little extended.
But it is a much better looking technical picture than we saw with that stock throughout the prior couple of years.
Dang. Another one that we saw over the past week was Alphabet, Google, whatever we want to call these days. Stock looked like it responded pretty favorably to results. I think the big news was that they said they were going to start paying a dividend for the first time. I know there were some headlines going around, some thoughts internally, like, is this the end of the growth stock or like the growth phase for Google? The idea being that they're not keeping money internally to reinvest in the company, but they're actually going to start paying it out to shareholders. I don't know if there's enough historical precedent to really say one way or the other. There's a few examples, but
yeah, I mean,
nothing too much
Meta announced they were reporting dividend last year, I believe, and the stock's done pretty well since. I mean, Apple first reported its dividend, I believe. Joseph did a piece in the report. I think it was 2005.
Microsoft done it for a while.
Microsoft started doing it. It's does not have to mean that the growth phase is over. I think from some of those, if you're just comparing Mag 7 name to Mag 7 name or whatever, Fab 5, whatever we're going to call those names now, it doesn't necessarily mean it's over. It doesn't have to be a bad thing.
Stock still looks great.
Yeah. And then, I mean, talking about another big name, Amazon also saw some notable improvement after its earnings. 2 consecutive buy signals, strong 5 for fiber, and it's a pretty good looking chart.
I saw a note from JP Morgan. I'll be brief on this. They talked about the big guys, so the Amazons, the Googles, how they've been more and more concentrated in the market, and they were like, "Oh, this is a problem for the momentum factor if these guys stop working." But I want to be clear, like that's a really, really long-term momentum because price has gone up. They've been a bigger weight. So yeah, I guess sure, technically, but like the momentum factor itself, actually, if those roll over, it would do great because
It could.
it could, yes, could do great because it can go own other things
Right,
in
exactly.
the market.
That's the great thing. Momentum self-correcting. If
Yeah.
it has something that's not doing well, it sells it and buys something else that is
Yeah.
doing well, right? So
It
it's
doesn't
not
care if
just
it's
because
been,
they're the big names. If they don't perform, they're not going to be
yeah,
in the high
they're
momentum.
held to the same standard as everybody
Right.
else is.
Exactly.
So I think that's an important note too on earnings. Like these big guys just keep running and running and running, and I think it's important to have a system that if it's not, at one point that changes, then
Like Apple.
like Apple, yeah,
Right.
Apple still has not looked great technically.
2 for fiber.
Yeah,
from an
does
entry.
not
And
look
by the
great.
time this comes out Friday morning, that could definitely change.
Sure.
If because earnings are, I believe they're reporting after close this afternoon on May 2nd. But right now, 2 for fiber, 4 consecutive sell signals, kind of a wide but notable range, about $40 range
Yeah.
it's been in. From that 166 low, it's now hit twice over the past 6 months, up to that 198 high. It can't quite break to 200.
Yeah, if that bounces really hard tomorrow, that's not going to age well. That's
Yeah, I
gonna-
mean, you're seeing 178 overhead resistance and that one, which is right around that 180 level where that trend line is going to be coming into play.
yeah. You
But
said this is after close today on
it is
Thursday?
after close on Thursday.
All
So
right, yeah,
I mean, a lot of speculation going to be around there
Sure.
regardless. But I mean, we'll see what shakes out.
yeah.
Yeah.
All right, I'm out of tabs.
Me too. So
Sweet.
I think that can probably call us for this. I hope everyone has a wonderful May the 4th. May the 4th be with you,
Oh,
right?
yeah.
And a great Cinco de Mayo thereafter.